What unfolded in the silver market at the opening of 2026 was not a fluctuation, not a technical distortion, and not a temporary imbalance caused by thin liquidity or holiday conditions. It was a structural event that exposed the real operating mechanics of a market that for decades had been sustained by abstraction rather than material constraint. Silver has long been priced as if it were primarily a financial instrument, governed by derivatives, managed through futures curves, and stabilized by institutional coordination. That framework only functions as long as physical delivery remains theoretical rather than demanded. In the first 48 hours of the year, that assumption collapsed. More than 17 million ounces of silver were demanded for delivery through the exchange mechanism, not as a hedge, not as inventory smoothing, but as extraction. In absolute terms, the number is already extreme. In context, it is destabilizing. Global mine production averages roughly 800 million ounces per year, meaning that in 2 trading sessions, over 2% of annual global supply was pulled forward and removed from visible availability before most institutional desks were even fully staffed. No industrial buyer behaves this way. No manufacturer suddenly requires that volume on a Friday afternoon. This was not commercial flow. It was a coordinated removal of inventory from the system itself. The timing was decisive because China's export restrictions became effective the same morning. For years, Eastern demand quietly absorbed excess Western paper supply, functioning as a release valve that allowed price suppression to persist without triggering physical stress. When that corridor closed, registered inventories in New York stopped functioning as a buffer and became a target. Those ounces represented the last easily accessible pool of large-scale deliverable silver remaining in the visible system. Participants who understood this reality did not test liquidity, negotiate spreads, or probe the order book. They executed immediately. This is why historical comparisons to 1980 are not exaggerations. In 1980, concentrated actors recognized physical scarcity before price reflected it and moved to secure supply. The critical difference today is that the actors are not external speculators attacking the system from the outside. They are core institutions embedded within it. The delivery data reveals behavior that had been absent for decades. Metal stopped circulating within the bullion banking network and began moving directionally. One institution was forced to deliver millions of ounces, while another absorbed that metal outright. This is cannibalization. Cannibalization only emerges when cooperative suppression breaks down. For decades, the bullion banking structure relied on a fragile truce. Obligations were rolled forward, metal was shuffled between vaults, and price was managed through synthetic expansion and mutual restraint. That truce fractured the moment scarcity replaced abundance. Under stress, systems do not defend structure. They defend survival. The raid on registered inventory was not opportunistic trading. It was a preemptive strike to secure physical metal before repricing renders access impossible. While this conflict unfolded at the wholesale level, the retail layer collapsed almost instantly. Major bullion dealers suspended sales, inventories vanished, and delivery estimates extended months into the future. This was not retail panic. It was supply failure. When a dealer refuses back orders, it signals a loss of confidence in replacement. Premiums exploded not because retail demand suddenly surged, but because replacement cost became unknowable. When banks raid the wholesale channel, mints lose feedstock, dealers lose allocation, and retail buyers are pushed into a scarcity auction disconnected from paper pricing. This is why retail premiums violently detached from spot. The paper price became an internal accounting reference for institutions, while the real market migrated to availability-based pricing. Vault data confirms this transition. Registered inventories collapsed toward levels mathematically incompatible with sustained delivery. Millions of ounces did not merely change ownership. They exited liquidity. When metal leaves the registered category, it does not return easily. It is withdrawal, not circulation. The same pattern appeared simultaneously in Shanghai. On the first trading day after reopening, with export restrictions active, the Chinese exchange experienced immediate inventory drawdowns as domestic buyers consumed stock, fully aware that replacement flows were cut off. When New York and Shanghai drain at the same time, the system is no longer redistributing metal. It is consuming reserves. At current rates, visible stock depletion exceeds daily global mine output by a wide margin. That imbalance cannot persist without repricing. The most misunderstood element of this event is the role of the largest bullion banks. This was not distress buying. The financial cost was trivial relative to bank capital. The importance lies entirely in intent. Fiat liquidity, which banks can access in effectively unlimited quantities, was converted into physical silver, which cannot be created. This was not defensive positioning. It was strategic acquisition. It signals that the largest institutions no longer trust future availability at current prices. They are front-running repricing, not reacting to it. This reframes the narrative entirely. This is not a retail-driven squeeze with banks trapped on the wrong side. The banks have already moved. The conflict is now bank versus bank, vault versus vault, region versus region. The spot price on the screen no longer functions as a clearing mechanism. It has become a lagging indicator detached from physical reality. The market has bifurcated into a paper layer used for signaling and a physical layer governed by access and availability. In such a system, paper dips are irrelevant because they do not generate supply. Inventory does, and inventory is disappearing. Part 2. Once a market crosses from abundance into scarcity, behavior changes permanently. Models built on equilibrium stop working. Risk management frameworks that assume replaceability collapse. What matters is no longer price discovery, but access priority. The silver market has now entered that phase. The most important shift is psychological, but grounded in physics. Participants are no longer asking what silver is worth. They are asking whether it will be available at all. This distinction matters because price is a negotiable variable. Availability is not. When institutions realize that future supply is uncertain, they stop optimizing for price and start optimizing for possession. This is why the recent delivery surge cannot be interpreted as speculative excess. It is inventory insurance. Banks are not positioning for profit. They are positioning to avoid exclusion. In a constrained system, the greatest risk is not mark-to-market loss. It is being shut out. This explains why financial cost was irrelevant. Hundreds of millions of dollars is immaterial when the alternative is losing access to a strategic input that underpins industrial supply chains, energy infrastructure, and technological production. This also explains why suppression accelerates depletion once scarcity emerges. Artificially low prices signal abundance in a market that is no longer abundant. Industrial buyers respond rationally by increasing consumption and securing supply. Sovereigns respond by stockpiling. The lower the price is pushed, the faster the physical drain accelerates. This creates a feedback loop where suppression deepens the shortage it is meant to conceal. Regulators understand this dynamic, but they are constrained by systemic risk. Forcing immediate repricing would expose the scale of synthetic supply built over decades. It would reveal how little metal remains relative to outstanding paper claims. That revelation would destabilize not just commodity markets, but credit markets, collateral chains, and confidence itself. As a result, containment replaces enforcement. The system tolerates distortion because the alternative is rupture. But containment has a shelf life. Physical depletion is not a narrative problem. It is a logistical one. Once metal is gone, it cannot be rehypothecated, rolled, or repledged. The system then faces a binary outcome. Either price rises to ration demand, or access collapses. In such environments, paper instruments lose relevance. Futures contracts, ETFs, and unallocated accounts become claims on a shrinking pool rather than ownership of a resource. When delivery pressure exceeds available stock, exchanges invoke force majeure, cash settlement, or rule changes to preserve institutional solvency. The market survives, the holder does not. This is why the current phase is not about trading opportunities. It is about structural positioning. Those who hold physical metal outside the exchange system are no longer participants in a price game. They are holders of an input that the system increasingly struggles to supply. This shift also reframes volatility. Sudden drops on paper screens no longer signal weakness, they signal desperation. They are attempts to slow demand by creating the illusion of supply. But illusion cannot manufacture metal. As inventory declines, each suppression event removes more physical silver from the system. The process becomes self-defeating. The silver market is therefore not approaching resolution through equilibrium. It is approaching resolution through exhaustion. At some point, delivery requests exceed available metal. When that moment arrives, price ceases to be discovered on exchanges and migrates to bilateral physical transactions. Dealers quote what they can source, not what screens display. Industrial buyers outbid investors. Availability replaces liquidity. This transition does not announce itself. It appears first as delays, then as premiums, then as silence. The most dangerous phase is not the spike. It is the quiet moment when inventory disappears and the market pretends nothing has changed. We are now past that stage. The delivery surge, the retail blackout, the vault drawdowns, and the bank-on-bank competition are not separate phenomena. They are a single-chain reaction moving through layers of the market. Silver is no longer discovering price. It is discovering hierarchy. Who has priority, who has access, and who is left with claims rather than metal. Once a market reaches this point, reversal is not a matter of sentiment or policy. It is a matter of geology and logistics. Supply cannot respond quickly. Demand cannot be eliminated without economic damage. The only remaining variable is price, and price moves last. Those waiting for confirmation on charts will discover that the decision was already made in vaults. The silver market has crossed from a financial construct into a physical constraint. The transition is irreversible on meaningful time horizons. The system will adapt, but it will adapt through repricing, exclusion, and structural change, not through normalization. What began as a delivery anomaly is now a resource event, and resource events do not resolve quietly.